Hayden, thank you for agreeing to talk to us today and share your story. I'd
My
like
pleasure.
to start with maybe you telling a little bit about yourself and your entrepreneurial journey so far.
Sure. So my name is Haden Kirkpatrick, and I'm the former CEO and founder of Odin Money, which was a neo-banking startup whose mission was to help the average American, unbanked, underbanked, or middle American consumer build financial stability and wealth through a combination of basic banking services, machine learning, and robo-advising wrapped up in a gamification layer. We started the firm in 2017 was when it was founded, and then we shuttered it early this year for lack of fundraising activity, for lack of a better word.
Okay.
So we made the best attempt we could to try and launch the company and get it going, but ultimately we failed and had to sunset it at the beginning of the year.
Got it. And then you guys were located in San Francisco, California, as far as I know, right?
Yep, San Francisco based for the founders and most of the core early employees. We did have some offshore development support and DevOps support from overseas.
Mm-hmm. And then, so industry-wise, it's fintech, right? And category neobank. And would you consider yourself seed stage or pre-seed?
Yeah, we would have been in the seed stage.
Got it. And then have you raised any outside capital from maybe angels or accelerator groups?
No, that was the big barrier for us to continue. We couldn't seem to get a check cut.
Gotcha. And then who did you see as key competitors at the time? Maybe at the time when you started out?
Yeah, so Money Lion, Chime, Green Dot, Rush Card. There are several competitors attempting to serve this space. One of the big issues we had with fundraising was there was a perception that the market was too saturated. So there's a series of fintechs that I just mentioned, as well as a few others, who have consumer-centric banking as their core value proposition. And then underneath that, every bloody fintech on the planet wants to launch a bank account and a deposit account. So there was almost a pincer problem where the market for the core services were relatively saturated. But then you had firms like Uber, right, launching deposit accounts for their drivers. And
Yeah, they launched like cards recently. I just read about it this week in somewhere outside the US. But yeah, no, everybody and their mama are launching debit cards and everything else these days, it looks like.
Yeah, it's a very hot market. And it's one that so looking forward into the future, it's probably unsustainable for a lot of these businesses for a lot of reasons. And there's a lot of problems with the value chain on this stuff, which we can get into in a second. But there was a pretty saturated market, and there's upmarket competitors from firms like Uber or Lyft or whomever that are launching deposit solutions for their drivers and folks that are in a similar segment to ours. And then there were a series of down market competitors that are just the pure neobank plays. They're going after this market and are relatively successful vis-a-vis the startup process, but are probably about to enter into a bloodletting phase that's just going to be hard to come out of. So
yeah. And then how would you evaluate traction? Like maybe in terms of employees or maybe users, subscribers?
Traction was actually an area where we didn't have too much problem. We did what we'll call generously a founders round, where we invested our own money and then got an MVP product out that was based on a financial wellness and fitness platform, machine learning based, and gamified to help people understand where their money was going and how they could grow it. And then to reward them when they actually executed the plan that we put forward. We ended up getting 7,500 users on that application over the course of 9 months, roughly. The intention was we're going to prove to the investment community that we can launch and iterate on product, which we did. And we were able to grow a base of customers to a certain point. But investors these days, it's almost like they want to de-risk the entire angel or seed investment process.
Which is impossible.
Which is impossible. So we started in 2017 by going out and saying, here's a vision, here's a solution and opportunity space in the market, and then justifying our team's skills and expertise against that, which was considerable. And the market feedback was, well, yeah, but do you have a product? What have you actually built? San Francisco is a very engineering-centric market, so investors are used to people that can get hands on keyboards and actually do this stuff. And we obviously needed to invest in being able to build out a product solution. So we went to build a product, launched it, deployed it, showed traction and growth on that, and then the investors started asking, well, where's the monetization? So every time you achieved an investor milestone, they wanted more and more and more and more and more traction. And at some point, it got to the point where we couldn't continue to bootstrap on our own funds. We couldn't monetize because the MVP was a freemium model, and not one that could command the interest of our customer segment. Is they're challenged, and we can get into some of their pain points in a bit if you want. But going to ask this customer to pay $2 or $5 a month for something when you're not offering the core value prop of a banking solution with bill pay and other things layered on top of it was just a non-starter for these customers. So the investors always seem to want to have all like a proven business model with market traction and revenue and profitability before they wanted to put investment into it. And that's just sort of backwards of how I understood the process going.
Yeah, no, sometimes the requests are coming. I'm like, well, at that point, we don't need your money anymore. We could just, self-fund or like do loans or something. Totally.
Exactly.
Yeah. And then at the time when you were launching it, like high level, what was the target market, like unbanked population? And then what was the market situation? How did you see, what was happening? What were the trends, or what led you to kind of in general start and work on this idea?
Sure. So roughly, let's back up. My founding partner and I have spent a lot of time in the subprime space in the United States and around the globe. I ran T-Mobile's $6.5 billion subprime business unit. He was my analytics, business modeling, sort of data officer, for lack of a better word, on that business unit. After that, I launched mobile wallets all throughout Southeast Asia for mobile telcos. And I've seen how mobile financial services can lift people out of poverty and create a banking infrastructure for those who didn't traditionally have it. Unfortunately, the United States is 32% unbanked, roughly, unbanked or underbanked, but in some sort of basic financial distress or without financial infrastructure. These are the customers that go to check cashing places or remittance houses or bill pay houses and pay exorbitant fees to access financial services that you and I take for granted. And that's been the customer I've served for decades. So I understand them well. We know how to reach them. And we just wanted to provide baseline financial services, which we believed is a basic human right at this point, and then use those to be able to create financial wellness for these customers. So there's this market down at the bottom end of the spectrum where you have customers that have been rejected by traditional banking. And there's a lot of reasons why. Let's just hold that aside for a second. The big banks don't want 1 in 3 Americans, and we think that's wrong. And we thought that was a big market opportunity, because it is. The people that serve those customers are they're almost usury level in their fees that they charge. They charge up to 350, 400% for simple payday loans. They charge sometimes 3 to 5% of the value of a check to liquidate it for just turning a printer check into cash. And it's riddled with fees all up and down the value chain, mostly because it's brick and mortar locations and they have not digitized their actuarial or underwriting methodologies. So we wanted to insert ourselves into that environment and provide lower cost services to these customers. Up market, something like 49% of Americans have less than $500 in their banking account and are one bad event, like a damaged car, God forbid a pandemic, away from utter financial destitute, right? So there is a more mass market play here, but our ultimate core approach was to disrupt the $300 billion alternative financial services industry and just target those customers militantly and pull them out of that usury system into something that's more cost effective and more accessible to them.
Yep. And then like you've got a lot of people signed up, right? So there's definitely need, and it talked to the market and the market accepted it. So what else worked in general from, what did you do successfully within the business?
Oh, wow. So I think the three biggest things that were successful was the design of the product and the way we architected the core value proposition, which was you come into the environment, you pay your bills, you hit your budgets, you hit your goals, and we reward you with points as a fungible asset. So a traditional bank will reward you when you swipe. They'll reward you to spend, yep, and consume. We were going to flip that on its head and reward you to save, invest, and do the things that have been proven to build wealth. So it was gamified to generate wealth, and you were rewarded based off of generating wealth. Because the more you save, the more we benefit as a firm, the better customers you are, which means the enterprise value of the company goes up, and we created this environment where you could share in that. Customers love that. They love the messaging strategy and the brand position, right? So they were bought into the mission, bought into the brand we wanted to achieve, and they resonated with both the product and brand matching together, and the attempt we made to attack the market from those positions. The last thing that users told us they really, really liked was the idea that we would be providing real-time, instantaneous financial services, basically providing prime-like services to subprime people, not treating them like second-class citizens. And that's sort of wrapped up in the mission and the ethos of the company. But it's also specific to their point of view and thinking they walk around the world today with such a difficulty engaging in the financial system, the market system. And we were taking a point of view from their side as opposed to the business side or the alternative financial services side or the banking side. And we were aligning ourselves to be on their end of the spectrum and to help them from that. And they could really empathize, and they felt that we empathized with them, and that we had a compelling point of view around how they struggle and how they live their lives. So between the empathy, the mission, and the initial product and how we designed the value prop, those were the three big selling points that helped us drive the traction we did.
Mm-hmm. And then my favorite question is about the challenges and fuck-ups. And then it includes, internal and external, definitely it seems like the market fit was not a problem in this case for sure, or the messaging and like aligning with your customers and understanding them. But what are some other challenges that you kind of ran into, including, fundraising? We can dive deeper into that one.
Yeah. Wow. So fundraising was the challenge. There are a lot of challenges in this environment, all of which sort of came to the fore at the fundraising tranche, for lack of a better word. Let's start with the market challenges and then work our way back. As we discussed, it's a pretty saturated market, right? So there were a lot of players that were earlier to market than we were. If my partners and I had started this thing in 2011, when we first had the idea, totally different game, but we didn't actually pick it up and start running with it until 6 years later. And in tech, that's an eternity, right? So we started late and we're a little bit behind the curve. We thought we had a differentiated value position and strategy, but hard to cut through a pretty complicated market like that. The second problem with the market was the perception that investors had around the customers. There was a perception that these customers were just shit customers. And the average investor has literally no idea or empathy in how these customers work or the way they struggle in their daily lives. I personally, I was maybe one step away from being one of these customers. I overdrafted from a bank account and got fee stacked and had a problem. Fortunately, I had parents that could help me with that. I have friends that didn't and still can't get bank accounts anywhere in the country because they have some black ball or something on their record in the bank check system that won't allow any bank, rather no bank chooses to write them.
Yeah.
So the conflation between the investors just had no empathy for them and couldn't imagine what their life was like, effectively saying that half of the country or a third of the country is not an acceptable investment target for them. The irony of this was we had the most interest from investors during the government shutdown of 2018, which protracted for like 2 or 3 months, and investors all of a sudden woke up and said, oh my God, I didn't realize that all these Americans were on the fringe like they were. And then the moment that stopped, those investors sort of went away. The immediate crisis was over and they just left. And these things continually happened, right? So we would have conversations around how good the customers are, how much they pay in fees to this other, they'll pay $120, $150 in fees to this other organization. I can charge them 10 and make hundreds of millions of dollars in revenue a year. That connection between the real world cost these consumers have and what the potential value to an enterprise was pretty broad.
Mm-hmm.
And we were just either unable to communicate it or they couldn't get past their preconceived biases. Don't know where it is, probably a mix of both, but we take accountability for that. The second big issue that we had was, as we discussed earlier, all the investors wanted to be proven model, right? And they wanted all of the fundamentals of the business to be aligned almost perfectly before they put their money in, which is just not how any of this
startups work. Yeah.
The last thing that we ran into was, and this is probably a failure on my part. I put together a business plan based off of my experience running a business, right? And I built, because we would be taking people's money in the form of deposits and holding it, I held us to a fiduciary level of responsibility. Meaning, when we rolled out our pro forma, we baked in margins. We sort of baked in additional cushion to ensure that we wouldn't have, we would not have problems with solvency, for lack of a better word. And then we target our raise on something that will allow us to get to the first phase of the roadmap and manage a just cost of service level of profitability, not net. I just want to know that I can get to the point where I can grow the base to cover the licensing fees, unit fees, marginal fees that I pay to my platform partner. And I want to have gross margin profitability. Because anything less than that, let me back up. I came to know that investors oftentimes play an investment game where they want you to invest and raise against a series of dollar amounts at ratios that are it's a market, right? And specifically, it's a market that is intended to keep you raising, right? To keep going and going and going and getting more and more and more and more and more money, which is fine. We had forecasted our Series A, Series B. We had that aligned to our roadmap and financial plan. But if I'm going to take deposits from somebody, I don't want to get into the point where I'm begging for money or I have to send those deposits back or shut down. And I've just ripped the service out from the people that needed it. This manifested itself in the business model needing $2.25 to $2.5 million and me constantly having to answer questions from investors. Why is it not 1.5? And I'd say, why is it 1.5 to you? And they'd say, well, that's just sort of what seed round raises are, like 1 to 1.5. That's just kind of, that's the range. Okay, well, I'm taking people's hard-earned money and I'm holding it in trust for them. And I'm not going to get into a place where I'm scrambling in 3 months to try and raise another round or we all go under and I have to send 50, 100,000 customers back their money and say, sorry, I broke this brand promise because you're not comfortable with the initial number. It was a complete disconnect between their business and my business. And the way I felt I needed to manage my business ethically to keep my brand promise and my mission intact, and the way that they felt they need to manage their business to keep their shareholders or whatever. Yeah. I mean, we just weren't on the same page. I was trying to build a business. They were trying to build a startup to the next round or a bridge to the next round. And that was something where I'm certain if I had come off of my position, we might have had a few checks cut, but it felt like a ticking time bomb that I wasn't willing to risk our company, or more to the point, our consumers on for the long term.
Yeah. That's really interesting, by the way. Yeah, no. Goddamn VCs. Kidding.
Well, it's super awkward when you're at a startup pitch event and somebody asks you that, and I said, well, because I'm building a business. I'm not building a venture machine.
Yeah.
And the whole the air gets sucked out of the room. And did he just say that? I'm like, we're going to have follow-on rounds. Don't worry.
Yeah.
I'm building a business first, a venture second. I mean, I'm building a proper business first, a accelerated tech venture second. Those things are not mutually exclusive in my brain. I mean, it's a difference of $750,000 to $1 million, which in the parlance of long tail fintech investment is really nothing. And from my perspective as an angel investor myself, if I have an an entrepreneur that I believe can get to cost of service profitability, that preserves my equity.
Mm-hmm.
So like if I believe that somebody can do that and achieve that, then I don't get diluted because he doesn't need to raise more money in further rounds. And I now have a bigger piece of a pie that is both more sustainable and more stable, which means my piece of the pie is better protected. But that's not necessarily how some of these things work. And
Mm-hmm.
Brett has recently coached me and educated me on the fact that some investors, early stage investors, at a next round will sell their shares to the A round lead or the B round lead or whatever and get out and walk away, and they won't be in it for the long haul.
Yeah.
So between having a dissonance between the investor community and the customer and our mission, and then a dissonance between their goals and my goals, we just couldn't bridge that gap. And frankly, I was unwilling to come off of some of those ethos. I just wasn't willing to sacrifice what I thought was right for the business and for the customer.
Mm-hmm. And I also think it's interesting because, to be honest, like what I've seen so far and on a global market, I'm not going to tie it only to the US since I was in the fintech space myself. Like it is actually becoming more of a norm for fintech companies to raise more money than what's considered like the average, right, on a seed round, just because your costs are so much higher, especially when you're building something this complex that requires licensing, right? We were doing broker as a service and asset tokenization. Like we literally needed to have at least $1 million just sitting in a separate custody account, right? If something goes wrong. So it's like you have to comprehend that, and like investors also need to comprehend, like, do you actually know what you're investing into, or like how the space works that you're considering to invest in, right?
And as an investor, when I hear somebody make statements that are so decoupled from the industry, I immediately know, like, so insurance company, for instance, right? There's a lot of insurtechs that get started up. And if they're saying they're going to launch an underwriting product for $5 million, they're nuts. Like they just don't have enough money to reserve against the losses and pay the reinsurers and get the value chain going. Might be a brilliant vision and strategy, but they just either don't understand the business enough, or they're just selling me something to get my money, right?
Yeah.
So I have observed in fintech more tech than fin, right? And that's fine in the short term, but that can be really, really bad in the long term if you're not being aware of what's going on and you're not really managing towards your portfolio costs well. And as an investor in those environments, I focus on unit economics. So our CAC was roughly half of what it would be for a traditional neobank. It was half of what it would be for a traditional app download in our space, a quarter of what it would be for a traditional fintech. And that's like based off of my knowledge of this customer cohort, my partner's knowledge of this customer cohort. We've built multi-billion-dollar businesses on multiple continents in a similar target customer genre. We know how to reach them, find them, talk to them, convert them. We get it. So as an invested-minded person, I would sit there and say, shit, these guys really know how to find their customer and convert them. Long tail, the numbers will sort of outpace the capital costs, and it'll be a healthy business. But not all investors think that way, right? They think like, what kind of check am I getting? What am I getting for it? And when am I going to get this money back? And I didn't want investors that were in it for the short term, right? I wanted investors that were in it for the mission, and they're just hard to find against this customer cohort.
Yeah, definitely. And then did you see any changes within the market itself that maybe like negatively affected what you were doing, except the fact that it's been like saturated?
Yeah, I mean, we finally ended up tapping out when all of this stuff hit, right? So the COVID crisis hit in February. The investment community, as is their job, kind of saw it coming a little bit in advance of when it actually hit. So we started seeing investments drying up in mid-February before the March stock market crash, right?
Yeah.
And so there's a case to be made that the macro market environment worked against us on this one. But ultimately, we were struggling with this issue for 12 to 18 months before. So I can't pin it all on that. I think the factors that we just discussed are probably more conducive to why we had trouble raising.
Yeah, makes sense. Yeah, because I was talking to a bunch of VCs when the COVID hit, and a lot of them just basically were looking at deals but not investing because most of the money were focused on, and time, right? They were focusing on existing portfolio companies and which ones they should save and reinvest more money in just to keep them afloat, which is ridiculous but necessary. but that's the new
And
reality.
I had some startups that I advised where the investors were asking for their money back.
Jesus.
So
That's not
yeah,
how it works, guys.
that's right. That's right. It's insane. And on
Yeah.
some level, we sort of shed a tear every once in a while as the team talks over happy hour or whatever,
Mm.
because this would be the
Yeah.
ideal time for us, right? Like we would be right in the sweet spot, hitting our stride in this environment. And unfortunately, we just
Mm.
couldn't get there. Yeah.
Yeah. Well, there are now a lot of groups and investors that are now investing like companies that were like solve the COVID related issues. So maybe there's a chance, it's a comeback chance.
Yeah, I'll think about that. See if I can come up with a virus or a vaccine that's investable.
That's investable. Not sure if it's going to work. But again, then my last question, and I like to kind of end on a happy note, like maybe some things that you're grateful for throughout this, challenging experience, or maybe some key learnings that you would love to share and be like, hey, do not do this, kids.
Yeah. Wow. So key learnings. Make sure you walk in knowing what you're willing to trade off. Don't get into a position where, like I was in, where I had a business model built and I was not sure whether I'd be willing to trade off terms for higher raise. Any sort of doubt in answering those questions are things that investors can sort of smell and suss out. And your ability to answer trade-off questions really tightly and succinctly shows that you've thought through them, and that you know what you're willing to negotiate around and what you're willing to accept. So that, I think, is the core, outside of the other learnings about sort of product market fit and how you talk to investors. That's where I felt I personally needed to be a little bit more buttoned up as a part of the process.
Mm-hmm.
As for things that I'm grateful about, I'm grateful for the lessons learned. I'm grateful for the team that I established and the way that they pulled their weight to help make this mission possible. The folks that we put together as a team were just really committed to what we're trying to do and really bought into the vision and did just some tremendous work. And I'm proud of them. And I'm grateful for having met them and worked with them. And I'm proud of the product we deployed and delivered.
Mm-hmm.
I'm also really, really grateful for the customers and the users that put their trust in us. Unfortunately, we could not fulfill that trust for a lot of different reasons, but they were still willing and able to put in anything from their email address and stay up to date, to sharing our mission and vision with their networks, to, for the MVP, handing over their banking credentials so we can help them become more financially fit. And those customers, there's always some of those customers out there that'll just sort of take a flyer on an app or whatever. I'm one of them. You're probably one of them. But those customers are the lifeblood and blood of all startups.
Yep.
And I would be remiss if not, I didn't thank those customers and be grateful for those customers, because they took a flyer on us when we had no brand equity or reason for them to do it. And unfortunately, we failed them. But to have customers respond to your value proposition and your product like that is something that all entrepreneurs should be grateful for.
Definitely. And it's definitely an amazing position to be in, to just even be early stage and be able to launch the product, to test it against the market, to have these conversations with users, because a lot of companies don't even get to that point, right? And die a lot earlier. So I feel like just that is a tremendous learning experience, and just in general experience, an adventure on its own.
It is.
Definitely. Yeah. Well, thank you so much for your time and sharing your story. I'm sure it's going to be very useful to a lot of other fintechy people out there trying to build something, and hopefully, even some investors, and maybe it will make them think and potentially change their minds of how they approach due diligence and talking to startups, hopefully.
We can always hope. But of course, if anybody watching this video or anything wants any advice, just point them my way. I'm happy to talk to anybody anytime.
Yeah, definitely. We'll drop all the links.
Awesome.